Good morning and welcome to Financial Accounting as we get very near to the end of the semester. So we can see everything now on just one calendar for the month of May. Today we'll be finishing up chapter 13. Fingers crossed that things go well. And so the chapter 13 exercises should be submitted by the end of the day. And then the chapter 13 problem would be due on Wednesday. This Wednesday and then next Monday, a week from today, will be our last new material classes. We'll be covering chapter 14. So as always, pre-quiz will be due on Wednesday, exercises due on Monday when we finish up the chapter. And then next Wednesday's class will be the drop-in review session for the week. It is at our regularly scheduled class time. That is actually class 30, as you've heard me say. But there won't be a regular class because we will have completed all of the new material. So you should come to class that day on campus or on Zoom if you have questions, if there's anything you want to go over. And if you are good to go, you do not need to attend class that day. I will take attendance as always, but as you know, attendance is not part of your grade directly. So it does not count against you if you're not here. And if you just want to come to hear what other people want to talk about, that's of course fine. Everybody is welcome. And if nobody is here, I will just go back to my office and be available throughout the day and the rest of the week if you do have questions. Then Friday, the 13th, is the official last day of the semester. That is also the last day that you can withdraw from this course or any other course or a total withdrawal from the college. For this class, that is the last day to submit any outstanding work, including Project 5 and Exam 5. So probably here on Monday the 9th, we will be taking a look at Exam 5, talking about what's on it, how many questions, what you can expect to see, take a look at the practice exercise set for this exam. Before we jump back into chapter 13 though, does anyone have any questions or anything else you want to talk about? So let me go over here and do a quick recap of what we talked about last class as we introduced the statement of cash flows in chapter 13. So what you can see on the screen right now is what I was trying unsuccessfully to find to show you a brief example of what the statement of cash flows looks like. So we can see the sectioning of this, and let me just get my annotate up here. So, like every financial statement, it has a 3-line heading, name of the company, name of the financial statement, and the range of dates that it covers. We can then divide this into operating, investing, and financing activities. So those are the 3 sections of the cash flow statement, the 3 sections related to each of the different types of activities. As you can see, the operating activity section has more in it typically than either of the other 2 sections, investing and financing. Operating activities is the only part that we did together in class last time. And as you know, we are only using the indirect method in this class. So the direct method is covered in one of the appendices to the chapter, but you're not responsible for that. So the indirect method means we start with net income. So we can see that right here. Net income comes from the income statement, of course, and then we have a series of reconciling items or adjustments to reconcile that net income to net cash flows from operating activities, which is the end result of this first section. Remember, you have that page that I call guidance for calculating operating cash flows. That page is in the reference materials folder for chapter 13 in Blackboard, and you can see a description with instructions of what do we do with this. There's a description of what types of adjustments come from the income statement, and we can see here examples of each one of those. So the first adjustment from the income statement is related to non-cash expenses, such as depreciation, as you see here, depletion or amortization. And the second type of adjustment is gains and losses related to investing activities, selling of plant assets, those long-term fixed assets, or selling of financial investments. If you see gains and losses associated with those, you know that there's going to be an adjustment here on the cash flow statement. The next section is the adjustments that come from the balance sheet. And there are 4 different scenarios. You could have an increase or decrease in a current asset, or you could have an increase or a decrease in a current liability. Every one of those is going to result in an adjustment. And again, that page of reference materials in Blackboard tells you exactly what to do for each one of those 4 scenarios, whether to increase or decrease, whether to show it as a negative or positive. So again, this is review from what we did last class. Once we have all of those adjustments listed with the appropriate negative or positive, we simply need to total that column, adding and subtracting as needed to come up with this number, the net cash flows from operating activities, and that is the key item, the most important number from the cash flow statement. So in chapter 14, when we look at financial statement analysis, we will be looking at, in addition to many others, we will be looking at some ways of analyzing our cash flows or cash generating efficiency. And each one of those calculations that we review is going to start with this number that I now have surrounded by the 2 green check marks. That's the single most important number on this entire statement. So that should sound familiar at least. We did a couple examples of that last class in exercise 3 and then exercise 9. At the end of class today, our final exercise, exercise 10, we will do the entire cash flow statement, which of course will include the operating section. So we'll have one more chance to practice with that together. And what we're going to start with today though is the investing section. Then we'll talk about the financing section before we pull it all together at the end of the class. So in the investing and financing section, as I mentioned last class, we do not use an indirect method. It is a direct method. It tells you exactly what we did. We received cash or we paid out cash for these particular activities. We know that investing activities is going to include the buying and selling of plant or fixed assets, as well as the buying and selling of financial assets as well. I know I just said as well twice in the same sentence. I shouldn't have done that. The second section here, the last section of the cash flow statement, is for financing activities, and that's going to include borrowing money, repaying the principal that we borrow, any activities related to our own stock. So we could be selling our own stock, we could be repurchasing treasury stock, we could be paying dividends to our stockholders. All of those are examples of financing activities. And again, we'll be using the direct method. It will say exactly what happened. Did we receive or pay out cash, and what was it for? The final piece here is reconciling the cash to the balance sheet. So before we move ahead to exercise 4 for this chapter, does anyone have any questions about what we did last time with the operating activity section or anything else related to cash flows? All right, well, let me clear my screen then. And we will get my screen to change. We will go to exercise 4. Let me make that just a little bigger. So as I said, we're starting, our first couple exercises are going to deal with the investing section of the cash flow statement. So we know we're going to be looking at buying and selling of fixed or plant assets, those long-term property, plant, and equipment kind of items that we looked at in chapter 9. So we'll be talking here about how that impacts our cash flow statement. The other piece that could be included in the investing section is buying and selling of financial assets such as stocks or bonds in other companies or government bonds. And remember, there could be that piece of showing a gain or loss on the income statement that would also affect the operating section. So the first thing we are looking at here for our first exercise says, we look at the general ledger and we can see that we had office equipment with an original or historical cost of $245,000. On that, we had recorded accumulated depreciation of $112,500 on the date of the sale. And then we sold it for $105,900 during the year. So a quick reminder, color here. A quick reminder of what this would look like. So on our balance sheet, we would show the office equipment with its original cost, $245,000. Then we would show how much of that has already been recorded as expense, which is $112,500. If we subtract that accumulated depreciation from the original value, that would give us the book or the carrying value. So those two terms mean the same thing, book value, carrying value. My computer, or my calculator is telling me my battery's low. Hopefully it will last through class, since I did not bring my phone to be my backup calculator. Give myself a little more room here. And so this is review from chapter 9. We take the original or historical cost, we subtract the accumulated depreciation to find out how much it's worth on our balance sheet right now. That's the book or the carrying value. Then we are told that we sold it for $105,900. Since we sold it for less than our book said it was worth, we are going to show a loss on that sale. And that loss would be the difference between the book value and the actual cash realized from the sale. Now, I know that the problem already gives us that number right here. But I wanted to show you where that number came from to remind you, again, this is not, these terms, these calculations are not anything new. But it's been a few chapters, so we've now reviewed where those numbers come from. And so, excuse me, when we sell the equipment, we remove the equipment, we remove the accumulated depreciation that goes with that equipment. We would increase our cash based on the cash realized from the sale. And we would, on the income statement, deduct this loss in the calculation of our net income. The question that we have to answer here for this exercise is, using this information, indicate the items that would be reported on the statement of cash flows. So you can see what our options are. It would be included in operating, investing, or financing activities, or it's not shown on the statement at all. And then if it is on the statement, we need to indicate whether it's added or deducted. If the answer in this column is that it's not on the statement of cash flows, then in this column we would choose it's not applicable because it's not on there at all. So of the transactions that are listed here, of the information that is recorded, and actually all 4 of these items appear in the same journal entry. So it says transactions, plural, but it's really just one transaction. It would be a credit to office equipment, a debit to accumulated depreciation. It would be a debit to cash for the selling price, and a debit to the loss on the sale of the equipment. And so those 3 pieces together, the 3 last items that I said would be debited, if you add those dollar amounts together, whoops, those $3 amounts will equal the $245,000 original cost of that equipment. And so we have one transaction that we're recording, 1 credit, 3 debits. In total, they would be equal. So let's think about this. Of these 4 pieces, of the 4 accounts that are affected in this transaction, one of them, I said, would be the cash account. So which piece of this actually affects our cash? Which one of these 4 numbers is the amount that would actually affect our cash?
Office equipment.
So the office equipment, that $245,000 represents the original cost. So whenever we bought this equipment, which was some time ago, I don't know how many years ago, but definitely multiple years ago. At the time we bought that office equipment, absolutely it would affect our cash when we paid for it. But does it affect our cash now when we're selling it? Did someone pay us the $245,000? No, that's the amount that we paid for this equipment, however many years ago we bought it. How much did someone actually pay us now that we're selling it? Problem tells us it was sold for $105,900, right? So our cash, with this transaction, our cash increased by that $105,900, the selling price. Selling the equipment, as we've just been saying, is an investing activity. Buying new equipment would also be an investing activity. When we sell this equipment, it appears on the cash flows from investing activities section, and our cash would be increased because we sold it for $105,900. Does that make sense?
Yes.
Okay, thank you. This $245,000 for the office equipment doesn't show up on our statement at all. I already explained it would be part of the journal entry, but it doesn't affect our cash. It did affect our cash years ago when we bought it, but not right now when we sell it. So we're going to choose the not applicable in the final column. The accumulated depreciation also does not show up on the cash flow statement. Again, there's a transaction, it affects the balance sheet, but it doesn't affect our cash. The only part of this transaction that actually affected our cash was the selling price. Someone paid us $105,900 in cash to buy that old equipment that we didn't need anymore. But because we are using the indirect method, we also have to take into account this loss. And maybe, let me go back and please just ignore the blue writing on the screen for a moment. Hopefully I can pull this up around that. I just want to go to this is the reference materials folder for chapter 13, just to remind you what we said right here. Excuse me. One of the adjustments, so it's letter 3B, one of the adjustments is related to the gains and losses related to investing activities. We said selling off this equipment that we're not using anymore is an investing activity. That loss already showed up on our income statement and reduced our income. Remember, our operating activity section starts with net income. So the fact that we included that loss related to an investing activity, we need to get that out of the operating activity section. It's not an operating activity, it's an investing activity. And so what I have highlighted here, letter 3B, says we need to remove them from our net income in the operating activity section. In this particular circumstance, we sold those, God bless you. We sold that equipment at a loss. And the instructions here tell us to add back any losses. And so back to our exercise, this loss is going to be added back in the operating activity section. And then in the investing section, we show the full impact to our cash of the $105,900 that we received for selling it. So again, the sale of equipment shows up, because there was a gain or loss, it shows up in two places on our cash flow statement. Any gain or loss is going to impact the operating section, and then the actual cash realized from the sale shows up in the investing section, as you can see here. The full transaction, the full journal entry, involves all four accounts: office equipment, accumulated depreciation, cash, and the loss. But the only two pieces that show up on the cash flow statement are the actual cash and then the loss, because we already included that in net income. It belonged there on the income statement, but it doesn't belong there on the cash flow statement, so we need to get it out. We add it back. I get my green check marks in there. Before we keep going, does anyone have any questions about this? I would encourage you again to make sure you keep track of that page of guidance in the reference materials folder in Blackboard. If you just follow along with those steps, you will have no trouble with the operating activity section. Just follow through each one of those steps. Everybody okay with this? Let's move on then. So looking at our next exercise, and I'm going to collapse that navigation panel over there on the left so it all fits on the screen. In our next exercise, we're still looking at the investing section. We're now talking about selling and potentially buying and selling land. So we're looking at the land account. This is a snippet from the land account in our general ledger. So let's just talk through what happened, and then we'll enter the information at the bottom. So what do we see here? At the beginning of the year, on January 1st, we had $925,000 in the land account. That means that we had, in the past, maybe all in one transaction, maybe in a number of different transactions, we had purchased a total of $925,000 worth of land. Now you'll notice something different on this exercise than in the previous exercise. That is, there's no reference to the accumulated depreciation, because as we learned in chapter 9, land isn't depreciated. We report it at cost or at what we paid for it, and we just leave it alone until we sell that land, if we sell that land in the future. So there's no accumulated depreciation to consider in this exercise. So let's move ahead to the next date. On March 12th, we purchased some additional land, and it tells us that we bought it for cash. So did that affect our cash? Do we have more cash or less cash than we had? If we used cash to pay for the land, we're going to show that as a deduction, right? How much did we spend for the land? $134,300, it tells us. And this is an investing activity. So it would show up in the investing activity section. It would say something along the lines of cash used to purchase land, $134,300. We would show that as a negative because it did reduce our cash. We used cash to buy that land. Let's move ahead then to the next date. And it shows us that on October 4th, we sold some land. We removed $89,400 from the land account, but it tells us that we sold it for $106,800. That $89,400 represents the original price of that land. That's how much we paid for it whenever we bought it in the past. Now we're selling it for more than we paid for it. We have a gain on that asset, right? So when we sell it, we receive some cash. Selling that land is also an investing activity. We received some cash, so we're going to add to our cash the amount of cash that we received when we sold the land. The actual cash that we got from the sale, $106,800. However, as we already pointed out, we had a gain on this sale. The gain, just like we talked about in the previous exercise, the gain is the difference between what we received when we sold it and what we originally paid for it. The difference between those two numbers is $17,400. On our income statement then, we would have reported a gain of $17,400. Because it's included in that income, it's going to affect the operating activities section because we use the indirect method. We start with net income. That gain is already included in that net income. And if we go back to our guidance here, it tells us to subtract any gains. So we're going to deduct or subtract that gain. In the operating activity section, that gain increased our net income, but it's not operating, it's investing. So we need to get it out of the operating section. Again, it belonged on the income statement. I'm not saying we did anything wrong by putting it on there. What I'm saying is on the cash flow statement, because we're using the indirect method, because we start with net income, we have to remove anything that's not related to operating activities, and that would be the gains and losses from investing activities. Any questions at this point? Questions anyone wants to ask? Let's keep going then. So we've now looked at gains and losses associated with investing activities and how those would impact the investing section. The next couple exercises deal with the financing activity section. And so as we reviewed at the beginning of class, the financing activities include borrowing money, repaying the principal that we borrow. As we pointed out last class, any interest we pay is included in net income, and so that's considered an operating activity. But repaying the principal that we borrow is considered a financing activity. It would also include any transactions that affected our cash and are related to our own stock. So if we buy stock in some other company, that's an investing activity. But selling our own stock is a financing activity. So issuing new stock for cash. If we buy back some of our stock, and we talked about in chapter 12, the purchase of treasury stock, that's considered a financing activity. If we pay cash dividends to our stockholders. That's a financing activity. And so as I said, in the next couple exercises, we're going to be looking now at those financing activities, so related to our own stock in this exercise. The board of directors declared cash dividends totaling $1.2 million during the current year. The comparative balance sheet indicates dividends payable of $250,000 at the beginning of the year and $100,000 at the end of the year. Our job then is to determine what was the amount of cash dividends that we actually paid during the year. And I think the easiest way for us to see this will be to put a T account here. It's going to also allow us to do a little bit of review from Chapter 12. So dividends payable, of course, it's a payable, that's a liability account. It has a normal credit balance. It's a liability, it's a current liability, normal credit balance. So what do we know about this account? The exercise tells us that it had a balance of $250,000 at the beginning of the year. Oops, extra digit in there. And then the balance at the end of the year was $100,000. So I'm just going to go down a little bit here. Maybe. And our ending balance was $100,000. So that's what we know so far. And that's, I apologize, that's very crooked. Pretend it's straight. Pretend it's that 90-degree angle coming down here. Clearly it's not. So thinking back to Chapter 12, we know that there are 3 important dates related to dividends. The first date is the declaration date, and that's what we're told in the first sentence of this exercise. The board of directors declared cash dividends totaling $1.2 million. What we learned in Chapter 12, on the declaration date, that becomes a liability of the company. Once those dividends are declared, they are legally obligated to pay them. If they never declare dividends, they don't have to pay any. There's no liability. There's no requirement that a corporation ever pay dividends. However, once the board of directors says, yes, we're going to pay them, now they actually have to pay them. And so on the declaration date, those dividends became a liability and we record the transaction. The debit is to dividends that will reduce our retained earnings when we close our accounts, the temporary accounts, and we record the liability. It does not tell us whether this was all at once, whether they declared quarterly dividends of $300 each. We're just looking at a summary here of what happened during the year. So it doesn't matter to us right now for this exercise, whether it happened all at once or $100,000 a month or $300,000 a quarter or $600,000 twice during the year. Doesn't matter. Our job in this exercise is to determine the amount of cash payments. So as we think about those 3 important dates, we've got the declaration date. That's what we just recorded here, the $1.2 million credited to dividends payable. The second important date is the date of record. But remember from Chapter 12, we don't have any accounting information. There's no transaction related to that. It's an important date because it determines who is going to receive those dividends, the owner of the shares of stock on that date of record. But nothing happens in our accounting records. Then we move ahead to the third date, which is the payment date. And that's what we're actually asked to calculate here. How much was actually paid? So what we really are trying to find is the number that goes right here. How much did we actually pay? How much came out of this account so that we started the year with a $250,000 liability. We added 1.2 million of it. And so we had owed a total of $1,450,000 in dividends, but at the end of the year, we only owed 100,000 of the 1,450,000 that we had owed at some point during the year. So what's the number we must have paid? Oops. To make this entry balance, to make this T account balance, we must have actually paid $1,350,000 worth of dividends. And that's what we're asked to find. So we must have paid $1,350,000 in cash during the year. It's the only way. We could have started with $250,000 in the liability, added $1.2 million to it, and ended the year with only $100,000 still owed. Why is that still owed? It's because of the change in, the difference between when they're declared and become a liability. So that $100,000 in dividends that's left at the end of the year had already been declared, but the payment date hadn't come yet. So there's a time lapse between the declaration date, the date of record, and the payment date. This $100,000 is how much carried over at the end of the year because it had already been declared, but the payment date hadn't arrived yet. So maybe it gets paid in January or whatever their first month of the next year is. Make sense? And so why are we talking about this here in chapter 13 when this seems like it's a chapter 12 thing? It's related to stockholders' equity. Because this $1,350,000 that we paid out in cash, that's the amount that's going to show up on the cash flow statement in the financing section. It will show up as a negative. It was a use of cash. It reduced our cash. We paid out $1,350,000 in cash dividends during the year. One more thing to talk about related to this exercise then. Where do all these numbers come from? If we are doing the cash flow statement for this company, how do we know these numbers? Where do we find this? Well, if I can, just want to get something here to spotlight. Okay, so right here, this $250,000 in the beginning balance, that's on the balance sheet in the current liability section. This ending balance of $100,000 is also from the balance sheet. This number, the $1.2 million, remember that's the debit to dividends. That's the value that's going to come out of retained earnings. This number we would find on the statement of stockholders' equity. It's not an expense, doesn't show up on the income statement, but it would show up on the statement of stockholders' equity. So last week when we started this chapter, I had reminded you the reason that we mentioned the cash flow statement in chapter 1, but then really don't talk about it much at all until the end of the semester, until the end of the class, is because we need to understand the other 3 financial statements first, because the cash flow statement includes information from all 3 of the other statements. We can see very easily already where some information comes from the income statement, such as net income, those reconciling items that come from the income statement, the non-cash expenses, and the gains and losses from investing activities. We need to understand the balance sheet because we need to be able to pull those adjusting items from the current assets and current liabilities. We just saw in the previous 2 exercises how changes in our long-term assets like land and equipment also have an impact on our cash flow statement. Now we can see how information from the statement of stockholders' equity also impacts the cash flow statement. So we couldn't reasonably even talk about the cash flow statement until we knew what those other 3 statements included. Any questions? Okay, we'll keep going. On our next exercise, we're looking at 3 separate accounts: the common stock account, the additional paid-in capital or paid-in capital in excess of par, common stock account, and then the retained earnings account. Collapse that again so we can see here. And you can see we're going to be looking at 3 separate transactions that occurred during the year, during the period. Yeah, I guess it is a whole year. And we're asked to, just as we did 2 exercises ago, we're asked to indicate where this would show up on the statement of cash flows. And the answer might be it's not on there at all. If it's on there, then we're asked to indicate whether it's added or deducted. And then the dollar amount. So there's 3 separate transactions listed here. And we're going to talk our way through each one of these. So the first thing it says is that we sold some common stock. So if I go up here to the common stock account, I can see on April 2nd, we issued common stock. We issued 30,000 shares. We added $1.2 million to our common stock account. That would be for the par value, 30,000 shares at $40 per share. That's where that number came from. But if we then look down at the next account, as we learned again in chapter 12, when we issue common stock, if it has a par or stated value, that's what goes into the common stock account. Almost all of the time, we're going to sell it for more than that par value. And so any extra, anything beyond the par value, so in this exercise, anything beyond the $40 per share gets credited to the paid-in capital in excess of par or additional paid-in capital. I like that term better because it's just shorter. Additional paid-in capital. You might see it either way. So on April 2nd, we sold 30,000 shares. How much did we sell them for? Well, it's the 1.2 million, which is the par value, but also the 720,000 on top of that. Adding those together, then that's $1,920,000. We sold those 30,000 shares for a total of $1,920,000. As you know, selling our own stock is a financing activity. Just repurchasing our own stock as treasury stock would also be a financing activity. When we sold the stock, did our cash go up or down? It went up. So how did we learn that, or how could we learn that? How would we know that? There's 2 different ways. One is by looking at what happened on the balance sheet. So we can see the beginning and ending balance in both of these accounts on the balance sheet. So we could have calculated how much did it change. The other place we can see a more detailed explanation, because it's possible that there's more than one transaction affecting these accounts. As you can see here, we issued stock and we issued a stock dividend. So we can see more detail about that on that statement of stockholders' equity that we covered in chapter 12. So the statement of stockholders' equity is going to be a good source of information for the cash flow statement for the financing activity section specifically. The second thing that we are asked to address is the cash dividend. And so, as you know, dividends reduce our retained earnings. Dividends reduce our retained earnings. And if we look at the retained earnings account, we can see that they issued a stock dividend at the end of June, which reduced our retained earnings. And we issued a cash dividend at the end of December, again, reducing our retained earnings. We're first asked to address the cash dividend. So I think it's pretty clear if we're paying a cash dividend that affects our cash, right? It's going to be a use of cash. It's going to be a deduction. a use of cash, and the cash dividend was $315,000. I don't know if we need to show that as a negative here, but definitely on the cash flow statement, it would be shown as a negative. It reduced our cash. Because it's related to our own stock, it's a financing activity. All right. Everybody good so far? The last section, the last activity then, is that we issued a stock dividend. So remember, in chapter 12, again, we talked about three different types of stock dividends. Small, less than 25%, a large stock dividend, which is 25% up to 100%, and a stock split. And each one of those three different types, different sizes of dividends affects our financial statements in a different way. A small stock dividend, we use the market value at the time the dividend is declared as a representation or as our estimate of the value of that dividend. And in that case, we would move the market value out of retained earnings, which is what you see here, and we move it into the par value goes into, whoops, I should scroll down just a little bit more. The par value goes into the common stock account, and anything above the par value goes into the paid in capital in excess of par. So we can, even if it hadn't told us right here that this was a 5% stock dividend, we would have been able to determine that it was a small stock dividend anyway. Because if it was a large stock dividend, there would be no entry here in the paid in capital in excess of par. A large stock dividend, we use only the par value. The reason for that, remember from chapter 12, the reason for that is because we assume that a large stock dividend is going to have a significant impact on the value of that stock. That the value is going to come down because now there are more shares out there with no actual change in the assets of the company. So we can tell that this is a small stock dividend. We can see that we moved a total of $450,000 out of retained earnings and into, between this and this, we moved the $450,000 into the contributed or paid in capital accounts. Did that affect our cash at all? No. It just said our assets are totally unaffected by a stock dividend. Our assets don't change, our liabilities don't change. At most, what it involves is moving value out of retained earnings into contributed capital. For a small stock dividend, we move the full value. For a large stock dividend, we move only the par value. And if it was a stock split, we don't move anything at all. We simply change the par value. And so the stock dividend, because it doesn't affect our cash, it's not reported on the statement of cash flows. And it asks us to put a 0 in the amount column if it's not included on the cash flow statement. There's no impact on our cash when we issue a stock dividend. And so, again, you can see how stock-related transactions would affect the cash flow statement. They're all financing activities if it involves our own stock. All right, any questions so far? I'll take that as a no. Let's move ahead to our final exercise before we look at that full cash flow statement in exercise 10. So we know that the financing activity section includes anything related to our own stock. We just saw that in the past two exercises, cash dividends, stock dividends, selling stock. The only thing we didn't see is buying treasury stock, and that's much less common. But if we were to buy treasury stock, that would, of course, be a use of cash because we were buying something, we were spending cash to buy that, and it would also show up on the financing section. Our last exercise, strictly related to the financing section, is related to our borrowing and repaying debt. It says, on the basis of the details of the following bonds payable and related discount accounts, indicate the items to be reported in the cash flows from financing section, assuming no gain or loss on retiring the bonds. So I'm going to make that a little bigger so we can see the whole thing on our screen. We have transactions in the bonds payable and in the discount account, and we are asked to look at three separate activities that happened related to these bonds during the year. This will allow us to do a little bit of review from Chapter 11, even though Chapter 11 is not on your last exam. So at the beginning of the year, we had $750,000 worth of bonds payable outstanding. That's the face value or the principal. But at the same time, we had $33,750 left in the discount account. So the carrying value of these bonds, I'm going to write CV for carrying value. Oops. So discounts have a debit balance, premiums have a credit balance. The discount reduces or offsets the face value of those bonds. So at the first of the year, the carrying value of these bonds was $716,250. That's how much the bonds were worth on our balance sheet. That's how much we owed in the long-term liability section of the balance sheet at the beginning of the year. Day two then, January 2nd, oops, that. January 2nd, we paid off some of these bonds, not all of them, but some of them. The bonds that we paid off had a face value of $150,000, but those bonds had $12,000 worth of discount on them. So the carrying value of those bonds as of January 2nd that we retired as of January 2nd, I'm being clear here. The carrying value of those bonds was, whoops, $150,000 minus the $12,000 discount, or $138,000. We were told to assume no gain or loss on retiring the bonds. That means if they retired them, they paid them off at exactly their carrying value. Not very likely, but that's what we're told, so we'll go with that. So when we retired the bonds, we paid them off at their carrying value. That was the $138,000. So the first transaction we're asked to deal with is the retirement of those bonds. And we retired them for $138,000. That means we paid them off. It's a use of cash, right? We paid them off. Because it's related to our own debt, it's a financing activity. So we would show that as a negative, a use of cash on the cash flow statement. Okay, make sense so far? The next thing we're asked to deal with is the issuance of some new bonds. Now, we talked about in chapter 11 why a company might do that. Why would they retire bonds on January 2nd and then reissue more bonds on June 30th? And it may have something to do with the interest rates. Maybe interest rates have come down. And so they want to issue bonds at that lower interest rate. It will save them money. The same thing if you own a house and you refinance because interest rates have come down. Businesses can do the same thing. And so let's see what happened on June 30th. The carrying value of those bonds, actually, let me write this differently. When we issued those bonds, the issue price, we call it issue value, is when we talk about price for a bond, we're usually talking about the index, the 109 or 102 or 97. So the issue value of those bonds on June 30th, it was $450,000, as I have highlighted on the screen. It was $450,000. That's the face value of the bonds. But down here on June 30th, you can see a debit of $30,000 to the discount account. So the actual cash realized from the sale or the issue of those new bonds is $420,000. Remember from chapter 11, they would sell at a discount if the interest rate we are paying is less than the market rate of interest. So we had to lower the price on our bonds. Even though the face value is $450,000, nobody would give us $450,000 for them because our interest rate is too low. So we had to lower the price or discount them in order to get them to sell. Issuing bonds then is also a financing activity. It's related to our own debt. Issuing new bonds, what did we get in exchange for the bonds? Cash. We sold them for cash. It increased our cash, not by the full $450,000 face value, but by the issue value that I have here, which is also the carrying value at the time they're issued. But I wanted to be clear that this is a new bond issue. Good so far? The last thing that happened here, the last entry in either one of these accounts that we have not yet addressed is this part, amortizing the discount. So again, thinking back to what we did in chapter 11 when we talked about paying interest on bonds. Most corporate bonds pay interest every 6 months. If the bonds are sold at a premium or discount, which is almost all bonds, maybe 99.99% of them, maybe even higher, are issued not at par, but either at a premium or a discount. And so when we sell the bonds, we record that discount or premium. In this case, they're all discounted. When we pay interest then every time, there's going to be a difference between the interest that we actually pay and the interest expense that we record. The interest expense shows up on the income statement, and therefore it affects our net income in the operating activity section, right? It's already included in the operating activity section. If I go back to our guidance here in Blackboard, and please just try to read around the blue writing on the screen. Number 3A here, non-cash expenses from the income statement could include depreciation, depletion, and or amortization. It could be one, two, or all three of those. So what do we do with that? Let me try to get it here around the blue. You can see maybe. Here we go. So what do we do with that? The expenses have already been subtracted on the income statement, but they did not affect our cash. And so we need to add them back to the operating cash flows. So that's our answer for this exercise. The amortization of the discount for 2625 has already been included. It's the difference between the interest expense and the interest that we actually paid. So we need to add that back in the operating section. Questions? So we've now talked about, so far today in our first hour, we talked about all the different types of transactions that might affect the investing activity section and the financing activity section of the cash flow statement. We have one exercise left for this chapter, and that is exercise 10. Whoops. That is exercise 10. And as I showed you last class, exercise 10 is a full cash flow statement. We're going to complete the operating, the investing, the financing section. Then we're going to have the reconciliation to the cash from the balance sheet, and then answer a couple questions. I'm going to again collapse that over on the side because I may need some of this white space to do some calculations. This exercise is also a bit more realistic than the previous exercises we've done because it does give us the actual balance sheet. Now, you'll notice that there are a lot fewer accounts on this balance sheet than on a company such as the company that you're using for your project. But by the time we finish this exercise, we will have looked at every single account on this balance sheet and thought about how it affected our cash. How did it change? How did it affect our cash? Remember that the two columns are in reverse chronological order. So the newest information, the end of the year, is in this first or left-hand column. And then last year's ending balances, which would be this year's beginning balances, are the column on the right. I want to start with this first account here, the cash account. What did happen to our cash account during the year? Well, it started at 14 and it went to 183. I like that they also use small numbers so we don't get lost in the zeros. So it started at 14 and ended at 183. Started at 14 and ended at 183. Our cash during the year, our cash during the year went up by $169. Our cash went up by $169. As I told you at the very beginning of this chapter last week, the function of the cash flow statement is to show where did those $169 come from. And so when we finish this cash flow statement, when we add together, I'm just going to point them out to you here. When we add together this, the net cash flows from operating activities, whatever that number is, and then this number, net cash flows from investing activities, and this number, net cash flows from financing activities, when we add together these three numbers, it better equal 169. If not, we've done something wrong. So again, I told you last class, if you like the balance sheet because you get to the end and you can see, oh, total assets equals total liabilities and equity. I think I've done this right. You have that same kind of check on the cash flow statement. These three numbers will add up to 169. Now some of these numbers may be negative. We know on net they need to be positive because our cash increased during the year. But certainly, some years our cash might go down. And so this would be a net decrease in cash. It would be a negative. So adding these three numbers together would equal a negative number. Some or all three of these numbers can be negative. So we've already addressed the change in the cash. Because we are using the indirect method, and that's the only method that we are using for this class, we know that we start with our net income or net loss. So let's see what we can find out here. The letter E here. There was a $62 credit to retained earnings for net income. In other words, our income was $62. It was a credit, so it increased retained earnings. That's a stockholder's equity account, has a normal credit balance. So we increased our retained earnings. If it had said there was a debit to retained earnings, that would be a loss. And we would start with a negative number. All right? Now, looking at our guidance page here, and I'm not going to keep jumping back and forth, but I just want you to keep in mind that this guidance page is here and it tells you exactly what to look for. Two different types of adjustments from the income statement and then the adjustments from the balance sheet. So from the income statement, we're looking for, did we have any non-cash expenses? Depreciation, depletion, or amortization? I don't see anything in there other than there were no disposals of equipment during the year. And we bought some new equipment for cash. So let's go up here to our accumulated depreciation, because it doesn't tell us, because we can't see the income statement. We have to figure this out on our own. You can see on the balance sheet, we have accumulated depreciation that was at $42 at the beginning of the year, and at the end of the year, it's $68. We know we didn't sell any equipment, so we didn't take anything out of that account. So the change from 42 to 68 is an increase of $26. We recorded depreciation expense of $26. In that page of guidance, it tells us those non-cash expenses, depreciation, depletion, amortization, reduced our income and need to be added back. So we're going to show that as a positive or an addition to our cash flows. That's the first thing we're looking at. It does not, it tells us that there were no disposals of equipment during the year, so there would be no gain or loss there. But it does tell us we sold some land for $120. Selling land, remember, is an investing activity. So when we sold that land, that increased our cash under investing activities. We sold it for $120. That increased our cash. But let's take a look at the land account. There's our land account. When we sold that land, we would have removed the land from the land account. How much did our land account go down? It went from $330 down to $250. It went down by $80. But it says we sold it for $120. We sold it for more than we paid for it. We would have had a gain on that sale, right? Again, on that guidance page in Blackboard, it says gains are included in net income and need to be subtracted back out. So that gain, what did I say the gain? Oh, I forgot the number. $40, right? Is that what I said it was? So we sold it for $120. Yeah. We sold it for $120, but we only removed $80 from our land account. So we must have had a $40 gain. That gain was included in our net income, but it's not an operating activity. So we need to get that out. And what we showed instead is the $120 we actually received from selling the land. The next set of adjustments comes from the balance sheet. We're going to look at our current assets and our current liabilities. So we'll start with accounts receivable. What happened to accounts receivable during the year? It went from 49 up to 55. It increased by $6. The first adjustment we have is an increase in accounts receivable. So when we talked about this last week, I said, ideally, you would recognize, why did our accounts receivable go up? Because we recorded the revenue, but our customers haven't paid us yet. So that $6 increase is included in this net income, but we don't have the cash yet. So we need to subtract that out. If you don't like thinking through it that way, if you go to the guidance page, you will see an increase in a current asset. Show it as a negative. Okay, so you have that step by step, tells you exactly what to do. And it's fine to use that if that's what it takes. What's our next account? Inventories. What happened to our inventories during the year? It went up from 99 to 117. It went up by $18. Increase in our inventories. How do we get an inventory to go up? Well, we buy some more inventory, right? What do we buy it with? Cash. So we didn't sell it yet, but we already paid our suppliers for it. So an increase in inventories, just like any other current asset, we show as a negative. The reason it's negative is because we had to pay our suppliers when we bought that inventory. Now, as we look at the rest of the accounts on the asset side of the balance sheet, we've already talked about, we've already talked about what happened in the land account. We've already talked about what happened in the accumulated depreciation account. The only one we haven't talked about yet is the equipment account. And right here in letter B down below near the bottom of my screen, it says equipment was acquired for cash. So we didn't sell any equipment, but we did buy some new equipment. Our equipment account went up by how much? $30. Went up by $30, and we are told we spent $30 on equipment. Buying equipment is an investing activity. Cash paid for purchase of equipment. We used cash. We're going to show that as a negative. So remember, I told you last class, by the time we finish this cash flow statement, we will be looking at every single account on the balance sheet and saying, what happened? Why did it change? How did that affect our cash? We have now looked at all of the accounts on the asset side of the balance sheet. So I'm going to go down here to the liabilities and see what happened there. We've already addressed all of the assets. We know what it changed, why it changed, how it affected our cash, and we've reflected that in this statement of cash flows. Now we'll start with the liabilities. And our first one is a current liability. It's an operating account. There are accounts payable. What happened to our accounts payable during the year?
Increased by $14.
Thank you. It went up by $14. What does that mean? It means we bought some stuff from our suppliers, but we didn't pay them yet. We held on to our cash. Strictly from a cash flow standpoint, that's a good thing. An increase in accounts payable means we already reported the cost or the expense, but we still have the cash. We haven't paid our bill yet. So an increase in a current liability, we show as a positive. Again, if you go to that guidance page, increase in a current liability, show it as a positive. Ideally, you would understand, just think that through and say, oh, it's a positive because we haven't used the cash yet to pay our bill. But if that seems awkward to you for any reason, just go to that guidance page and it tells you exactly what to do. Well, since we finished this section, and the only reason I know that is because we're using a template and we filled up all of the spots. If we didn't have this very handy template, we would just have to keep going and not put in any totals until we've made sure we've covered everything. But I can see that we've filled up all of our spaces. So I'm going to go ahead and total this column, starting with the net income. Make sure you add and subtract based on the signs that are there. But go ahead and fill in that column. My battery's still holding out here, so. And I got a net total of 38. Is that what everyone else got? So as I told you at the very beginning of class today, when I showed you that example of a cash flow statement, that number, that $38 net cash flow from operating activities is the single most important number on this whole cash flow statement. If you are analyzing a company, that's the first number you're going to look at on their cash flow statement. Because while it's interesting and useful to know, are they investing in their company? Are they spending money on acquiring new assets? Are they keeping up with, the wear and tear on their equipment and replacing it as needed and things like that? It's interesting and useful to know if they issued new cash, if they're paying dividends to their stockholders, are they paying their debt? That's all useful information. But for long run health of this company, we need to know, are they generating cash based on their operating activities, which is the reason they exist as a business. Again, we can see looking at the investing activities that we have filled up all the lines. So I'm going to go ahead and stick in my total for those as well. But we only know that because we have this template. Otherwise, we would just keep going and put in the totals at the end. I want to remind you, again, that this net income could be a net loss. That number could be negative. The total of the adjustments could also be negative, as you see here. So the net cash flow from operating activities is lower than their net income. It could be that the net cash flows from operating activities was negative. It's not a good thing, but it absolutely happens, in particular with brand new companies, or companies that are struggling, of course. Looking at the investing section, we happen to have a positive or cash inflow from investing only because they sold that chunk of land. When you are looking at a company, if you want to know they're investing in the future of their company, if you want to know if they're growing, you're really generally looking for a negative number in this investing activities, that they're spending money to buy new equipment, to expand, to grow, to replace equipment as it wears out. Ideally, we're probably more so looking for a negative number in that investing activity section. We just happen to have a positive here because they sold that chunk of land. All right, let's keep going. What happened here in dividends payable? Remember, we reviewed this already a couple exercises ago. So a letter F here, it tells us that they declared $24 in dividends, but did they pay all of them? No, because there's still $5 sitting in dividends payable. So they declared $24, but they only paid $19 of the $24, and $5 is dividends payable. So under financing activities, here we go. So there's no right or wrong order to put these in. I just had to find where it was in the template, but this easily could have been the first item listed. Cash paid for dividends. We declared $24, but we still owe $5 of it. So we paid $19. That's a use of cash. It's a cash outflow. We show it as a negative. What happened next? Common stock and the paid-in capital in excess of par, both of those increased. So what do we know about that? The letter D here says the common stock was issued for cash. That's a source of cash. It's a cash inflow. We sold some stock for cash. Well, how much did we sell? Well, our par value went up by $45 from 80 to 145. And our additional paid-in capital went up by another $15. So 45 in par value, we must have issued 45 shares because it's a $1 par value. 45 plus 15, we must have sold those shares for a total of $60. And as we already said, that's a cash inflow or a source of cash. So we're going to show that as a positive. I want to just go back up here for a minute and make sure we've talked about the changes in each one of these accounts. So we did accounts payable, talked about dividends payable. We've now looked at the common stock and the additional paid in capital. Let's look at what happened in retained earnings. So we started the year at $438. We added to it $62 for the net income. So we started at $438, added 62. So that would have put us at $500 even. But then we subtracted $24 for the dividends that were declared, and that would take us to $476. So we have now reflected all of the changes that happened in retained earnings as well, because we dealt with the net income in the operating section, and then the cash dividends that we paid, we addressed in the financing section. So we're ready to finish this up. We have looked at all of the information, the additional information that was given here, and we looked at every single account on the cash flow statement. Sorry, that's not what I'm going to say. Every single account on the balance sheet. So let's put in our total here, 60 minus 19. We have $41 worth of inflows in the financing section. A typical question you might be interested in if you're analyzing a company is, where do they get the money? What sort of, what sources of financing do they use? And so you're looking in the financing section for the positive numbers. So for this company this year, their most important source of financing, or their biggest source of financing, was selling stock, because it brought in $60. This also tells you, if you're an investor, that they are paying dividends. So that's nice information to know. If they had long-term debt, now we don't see any for this company, but we know that most companies do have long-term debt of some kind on their books. If they had long-term debt, you'd also want to look here in the financing section to see if they're paying off that debt. Do they have any large negative numbers showing that they're paying off those liabilities? This company just doesn't happen to have any. Now, we already know that the increase in cash should be $169, because we looked at what the balance sheet showed. Started at 14, ended at 183. But I just need to check that. I need to add together the cash flows from operating, from investing, and from financing activities, and make sure that they do add up to the $169 that we know it should be. And it does. And so we get a gold star. We have accomplished the purpose of the cash flow statement, which is to explain the change in cash. We already knew from the balance sheet that it went up by $169. Now we know why. $38 was from operating, $90 from investing, and $41 from financing activities. And now we can go ahead and answer, excuse me, now we can go ahead and answer these two questions at the bottom. Was this company's net cash flow from operating activities more or less than net income? Well, the operating activities were 38, net income was 62. So the answer is it was less. It's not what you want to see. We call that ratio of those two numbers is called the cash flow yield. And we want that to be more than 1. We want the cash flows from operating activities to be more than net income, ideally. What's the source of the difference? And I assume now they're talking about the difference in the cash flows from operations. So let's look up here. The biggest difference, the biggest number is gain on sale of land. The next biggest is depreciation, then an increase in inventories, followed by increase in accounts payable. So it gives us some choices here. The biggest sources of difference is the gain on the sale of land, the depreciation expense, and changes in current operating assets and liabilities. So is A, D, and E one of the choices? So the other options there, purchase of equipment, that's a investing activity. Sale of common stock is financing, and dividends paid is financing. So I've made the assumption that what they're asking about here is the source of difference in between the cash flows from operations and net income. Sometimes we have to read into what the question's really asking. See, it did like my answer, so yes, that is what they meant, what I thought they meant. So that is actually the end of this chapter. We're finishing up a little bit early today. Does anyone have any questions about the cash flow statement? All right. So that is the end of chapter 13. We will stop here and call it a day because we do have plenty of time with our remaining 2